5 o'clock, so we will begin the meeting. The first item on the agenda is the evacuation procedure. First of all, might I now welcome Mr. Stallone, our independent person, to our meeting this evening. Thank you for coming. The evacuation procedure is, we are not expecting the fire alarms to sound. If they do, we exit by the door over there. If you need any assistance evacuating the building, please let us know. And then we go out of the building, down the main stairs to the Yorkshire Bank on the opposite side of the road. Apologies. Are there any apologies for tonight's meeting? We have none. Thank you. Item 3 then, minutes, to confirm the minutes of the meeting of the Audit and Standards Committee held on the 13th of November 2018 on page 4 of your document. Do we agree that they are a true record of the meeting? Agreed. Agreed? Okay, thank you. Right, item 4, declarations of interest. Do we have any further declaration of interest other than are already recorded in the minutes? No? Okay, thank you. Item 5, public consultation. We don't seem to have any members of the public, so we'll move swiftly on to item 6, which is the Nuneaton Bedworth Council External Audit Plan, year ending the 31st of March 2019. Welcome, as usual, to Grant Thornton.
Thank you.
This is your report, Grant?
It is, yeah. It's just me tonight, so I'm taking both reports. So thank you, Chair and members. Yeah, we've got 2 reports on the agenda from us tonight. One is our plan for this year's audit of financial statements, and then the second one is what we call informative risk assessment. And you will recognise when I go through this one that there is some linkage between the 2 as we go forward. So I'm sure a number of members have seen the plan before. It's not significantly changed from prior years. So just to remind members, the key outputs from our audit are an opinion on your financial statements, that they give a true and fair view of the council's financial position, and assessment of your value for money arrangements that were in place with the authority during 18-19. One element to bring yourself to your attention this year is we're still in discussions with Craig and some in the team around NABSAL. That's not an issue with the company itself, it's just the size of the company. And if it gets to a certain size, then it might become a material investment item in your accounts, and therefore it might trigger the requirement for group accounts. I think we're still going through that process of assessing the size of the company this year. In prior years, it's been small enough that you make a disclosure in the financial statements, but you're not quite to consolidate it. So at this point in time, we'll still wait and see what the outcome will be. If we have to do, if you have to do group accounts, I will come back to you with an update to the plan to say how we will address that. Although, as we will be able to access a lot of the systems of the company, I would imagine we wouldn't have to rely on the external audit of that company. We'll be able to do specified procedures, but that would be my initial assessment. So that's really about the only main change from what you've seen in prior years. What I'll do is maybe take you on to, I think it's on page 13 of our report, or page 4 of our report, which I think it's 13, I think, sitting on in your statements, in terms of key matters that we've considered when we're planning the audit, key matters impacting the audit. You'll not be surprised to find that we're considering the financial pressures that the council's under, and I'll come on to that a little bit more, how that's driven their value for money assessment. Changes to the accounting standards this year, not many. There are 2 key standards coming in, IFRS 9 and IFRS 15. IFRS 9 is to do with the way you account for your assets and liabilities as well, and disclosures. And this does link into a paper that Craig will take you through at the end. You have one investment, which your CCLA investment, which you think will be directly impacted by that standard. and how you need to account for it. But it does bring in some other issues around accounting for impairment losses and elements like that, and the way you calculate those. But we're not anticipating that having a significant impact on the accounts. And IFRS 15 is to do how you recognise revenue, your income, given the way the nature of your income. Again, we're not anticipating that having a significant issue, but we'll have ongoing discussions with Craig and the team. You will see me using a slightly different terminology this year. Our new audit approach is called LEAP. If you've heard me talk about Voyager in the past, we're now on LEAP. You shouldn't really see any impact on that, on you as a committee. That's really for us. What it really does enable us to do is better tailor our audit for your risks, as opposed to doing a sort of generic, we test everything as part of going forward. So that hopefully gets a more efficient and more effective audit from your perspective. But you shouldn't really notice any significant differences on that. And probably just recognising there clearly during this financial year you've had your management restructure, moving to the sort of 2MD model. Just to keep, we are monitoring progress on that from what I've been reviewing in your cabinet reports. I haven't seen any, you're still online to hit your strategic objectives, so it seems to have settled in and be progressing as you would expect. So we don't have any particular issues or external audit around that, but we just will keep an eye on it. Probably as you'd expect us to do, and form an independent view as necessary. So I'm not going to go through a detailed audit approach. It didn't really change significantly from last year. In terms of significant risks we've identified, so I'm now on to page 15 in your pack, on page 6 on our report. Presumed risks, I think as I said before to members who've been around this table before, I have to assume there are two significant risks I have to assume might be in place. One is revenue recognition, which I can rebut, and as I alluded to earlier, we've looked at your income streams and we're satisfied about the controls and arrangements on that we can rebut that. So there's no additional audit work that I have to do around revenue recognition. That's not to say we won't audit it, but it'll be part of our standard audit procedures. The one that I always say go about management override of control, I cannot rebut that one. I have to presume there is a possibility that your management might override the accounts. That's not saying they are, but I have to plan my audit to assume that how could they do that. And as usual, the primary risk of that with journals. So we will be testing your journals and where you can move money around accounts, necessarily without going through your accounting systems per se. And then on to page 7, page 16, the two significant risks in terms of what's in your accounts that we do look at are valuation of your property, plant and equipment, and valuation of the pension fund net liability. Primary reason for that is they are estimates, and they both involve a significant amount of judgment from experts, and therefore there is a significant risk that if any one of those assumptions are slightly different or out, then you could have a big change in the numbers. So we have to take additional audit procedures in relation to those, and I don't propose to go through those bullet points. I'm happy to answer questions on them, but those are the two that we will be reporting directly back to you upon. Other matters is I'm not going to go into detail, that's our other roles and responsibilities as your auditor. But moving on to page 9 and page 18 in terms of materiality, in terms of looking at the audit, in terms of the materiality we've determined for this year, we've determined as an overall level to keep it the same as last year. As a public sector body, we consider to be expenditure to be at the best benchmark to consider against. If you're a commercial entity, we might be looking at income, because that's if you're profit making, you'll want to generate income. As a public sector body, you raise tax and then you spend it. So our view is that the public, or the readers of the accounts, will be interested to see how you spend it, and therefore, in terms of that. So that does, when you plan it out, still be around about 2% of your expenditure, which is similar to last year and was in the range that we think is acceptable to materiality. And that does reflect upon the fact of there's no great issues at the council, and we've not found any really in the past that we would say is systemic. We've had the odd issue around pensions and things like that, but it's not something that necessarily under your control. In terms of value for money, as I say, I do have to give a separate opinion on value for money. We've had, as I say, at the moment we're comfortable with the way that the new management arrangements are bedding in, and therefore our focus at the moment really is on your financial position. I know that sort of comes in a little bit to what Craig will allude to a little bit later around treasury management, but it is picking up on the point that it's still a difficult time for councils, public sector in general, and the level of savings that you've got to attain. So what we will be doing is focusing upon your arrangements to address those savings. You, as a council, historically, you've been able to make those savings. But I think we're just beginning to recognise it's getting harder for a lot of councils going forward, and certainly as a firm we've recently issued a report around, if you look about 10 years in front, then maybe about a third of councils might be struggling going forward, depending as the reserves levels deplete as we're going forward. So we're not necessarily looking that far ahead as part of value for money, but we will be looking around how you are going forward. And we do recognise that most councils are struggling when it gets to 2021 because there's still uncertainty around business rates, etc. So we're putting it in the framework of that, but it is the area of audit focus for us. So that really is the overall arrangements. The team, just to remind you that I'll be the engagement lead. Javid has come back from last year, so we'll continue to be the audit manager, and then Will, who you know already. I'm not going to go through early close. We did address, we met the timetable from last year. I'm confident we'll meet that again. I know Craig is looking at strengthening his team to help him get through that process, but at this point we've no issues. And I have to just say, in terms of independence, I can confirm we remain independent. 2 pieces of work we do for you, which are, I suppose, audit-related, non-audit services, if you can have such a thing, are the certification of your pooling capital receipts claim and your housing benefit claim. So we're just saying that we do those additional pieces of work. So that's the audit plan.
Okay, thank you. Does anyone have any points? Councillor Trent.
Thank you, Chair. Thanks, Grant. That was very awesome as usual. Couple of things I'd just like to ask. In the light of the several recent auditing scandals that there's been, and a general perception and commentary in the media about auditors being too close and cosy with their clients. In fact, you said you haven't significantly changed your methodology this year to previous years. What challenges have Grant Thornton applied, and have the council given you to say, well, is it right that you're just doing the same thing again this year? I mean, it might be, but what challenges there been? What process have you guys been through to examine the process you go through and make sure that it is still going to find the things we need it to find?
Great question. In terms of that, I mean, in terms of what we do, I suppose when I say where we've landed in terms of risk, the overall risk pattern of the council hasn't changed, which is where we've ended up here. When we're planning the audit, you're quite right, I sit down with my audit team, we would have looked through your minutes, we would have looked through your reports, and we do cast scepticism, and we do look for changes in the accounts. So we do, so I think it's probably a level under this audit plan, which doesn't necessarily come through. So we will be looking at, are there any significant investments in capital? Are there any sales or that we'd expect to see going through the account? So we're aware underneath that as a level we need to look at. And we don't tell Craig exactly what we're going to do. We will always test something different in the year, and we are required to make sure that we don't, as is quite right, suggesting.
Off.
However, I mean, in that sense, we have to be realistic. Craig will know that we will come along and we will test operating expenditure, we will test your income, we sample that, and we use that sampling to gain that assurance. So I don't know what I'm going to sample this year, to be honest. What I can vary is the number of sampling. So if I feel that there's an issue, I can test more. At the moment, we'll pick those items. We get a full download from your accounts. We then use Idea, which is a software package, to randomly select items to pick. So if there's an item in your account, I don't know what it's going to be right now. Craig doesn't know what it's going to be. So we then look at it. And then that's where our professionalism comes in, is looking at the evidence you provide and providing that scepticism, say, is it appropriate audit evidence, or does it indicate that maybe there's something wrong with it? So that whole bit of process goes through it. So I don't think we're too close to you in that sense. Part of that is looking at your audit fee. It's centrally set now. You're part PSAA. There's no influence on me, to be honest. It's for me to keep independent as well, which is one of those arm's length approach, which I think actually, interestingly, in the recent Kingland report was saying that, I'm not saying the audit commission will be brought back, but it was saying that he thinks in the public sector that idea of having an independent body to a point, which PSA sort of does a pseudo role, is a good idea. But because of that centralised contract, there's no pressure on me to be overly nice to you as a council. I'm here to do a job, I'm a public sector auditor, I'm here to give the independent view. So there is no incentive for me to do that. And if you look at, and that's why we report the non-audit fees to you as well, so you can see that actually it's about £11,000 and it's about 40% of your fee. So it's not more than your audit fee, and that was one of the criticisms in the commercial sector.
Indeed.
And you've seen a lot of firms pull out now. If you look at the bigger firms, they're not doing it because they recognise the risk. So I'm comfortable with what we're doing, and as I say, we do throw some random things in that we don't tell you what we're going to look at.
Thank you for that. The topical follow-on is, business has gone down today, a national high street chain, because of this. What assurance do you have that the council or people in the council aren't operating a secret overdraft facility?
Right, okay, yeah, I think you're referring to one of our current clients or former clients. Yeah, that I have to admit, I've seen that come out, and I think that's a challenge. And how do I affect that completeness? What we would look for, I think, is unusual patterns within your expenditure and things like that. Is there anything coming or income? And that's where that revenue rebuttal, whilst we're comfortable at the moment, is we can look at your income streams. So if you are borrowing, we also do circularise the banks, but I know, to be honest, it's a difficult test for us to find out if you've borrowed from someone we wouldn't expect you to borrow from. We will work around how we can do that. But I think we would expect to see if you've undertaken borrowing and there's expenditure going out, we will try and link the two together and go, where's that trail? Yeah. Where would it go? I mean, if we pick that and say, well, where's the interest going? You must be paying somebody if you've taken out the borrowing. But also, I think you've got to take a step back. Is you've got internal audit, you've got controls around this about who can actually set these bank accounts up. And it normally takes 2 people. You've got a control environment around. It would need collusion to do that. And you've got appropriate segregation of duties. So I think you have to look at your own control environment, because that's where it starts. I think there's always the inherent risk of fraud, which is why we have those 2 standard audit risks. So I think you have to look at your own. First of all, you have a strong control environment. You have your own internal audit. You've got good segregation of duties. You start there, and then you work out from how could somebody do that, which is why we look at those journals as well, because that's where we think they'd hide it. So.
Thank you. One final very quick question, just on the recognising income, and you touched on that again in your answer there. So the new homes bonus, what's Grant Thornton's, what's your experience of other local authorities' treatment of new homes bonus? Do they treat it as pure revenue, pure income, or do they typically ring fence it and say, no, it can only be used for capital expenditure? Or what's your experience?
It depends, to be honest. I think I have some that have used it as effectively as RSG's gone down, revenue support grants gone down. Effectively, they've used the new homes bonus.
And that's acceptable to do that?
It is, there is no, whilst it's called new homes bonus, it's not earmarked in the sense you have to spend it on that. It's your revenue. We do look at that, I suppose, as part of that's where it fits into BFM and financial sustainability, because the way the government has extended the scheme, you can't, what are your plans if that reduces? In other words, if you don't hit your new homes bonus target, you get a reducing amount. So that then fits into the medium-term financial plan. I think I've seen some councils where they can, and that some of it is, I'll be honest, it's down to affordability. If they can, they would ring fence it or not put it into the base budget. But it depends on the individual councils. So what we do is talk to the individual councils on a one-to-one basis and go, well, okay, is it into your core budget? Where is it going to go? And if not, what's your plan going forward if you don't hit your building targets to replace it? So it builds into that whole medium-term financial plan and assumptions.
Thank you very much. Thanks, Chair.
Thank you, Grant. So I think yours is the next one as well.
It is. Actually, this is work for the committee, to be honest. If I go straight to page, I think, 26 in your pack, the purpose of this report, as I say, part of my role as your auditor is to talk to you and to management around the processes and arrangements you've got in place in relation to fraud, law and regs, going concern, related parties and accounting estimates. So this is talking to you about what you've got in place. And the standards require us to communicate on certain elements. We in the past, it could just be a letter to the chair of audit committee that then either Craig or Simone would have answered. What we've looked to do is, in a way, put that into a report. So what we've gone through the items we have to ask you, and then we've sought management responses, and this is what this report is. And then what we've then looked at as your auditors go, does that stack up to our understanding as the auditor? Yes. So now is the opportunity for me to play it back to you to say, these are effectively the representations I've had from your management on these areas. Do these reflect from your role as those charged with governance, are they consistent with your knowledge and understanding of the council, or are there any questions that you might want to ask me, or is there any comments you'd like to make? So I wasn't actually going to go through this in detail, but where it does pick up on elements is there's a fraud risk assessment, there's an element of going concern which I referred to in the plan as well. And I mean, we do draw heavily upon the work that is done by sort of internal audit and elements like that. So these are your management responses. I am comfortable with the responses, but it's your opportunity now to, I suppose, ask me and then maybe if there are officers around the table who have specific questions to say, are they consistent with your knowledge and understanding? And then if anything come out of that, we will either tweak our audit plan or reconsider it. But that's where we are. And then the back is the accounting estimates, which I've really gone through in a bit more detail.
Okay, thank you.
So I wasn't going to go through it page by page unless
If there are
Yeah.
specifics on a specific page, we can point them out to you, yeah. Any questions?
Just the one question, and it's for you, and I guess it's for Simone as well. I assume that both Simone and Brent and all the directors actually get a copy of this and sight of this, so that they can flag
we
up.
go through Craig as our point of contact, and I look to Craig to share it appropriately with the relevant people.
The relevant people that this has been shared with to actually come up with the management responses has been myself, Simone, Phil and Linda, because they're the key areas and the key people that need to formulate these responses. All the directors would receive a copy of this as part of the agenda pack as well anyway. But yeah, the key officers that I would approach for actually formulating the management responses are the four I just mentioned.
Thank you very much.
Okay, thank you. Grant, thank you very much for coming along. I think we see Grant at almost all of our audit, committees. I was at a combined authority meeting, it's got a fancy name, but we'll call it the audit committee of the combined authority last week. And Grant gave a really easy, even for me, to understand idea of what exactly an external auditor does. So I've had a word, and Craig has had a word with Grant, and we're going to set up a training session for all members, and Grant has agreed to come along and explain to members exactly how external auditors work and exactly the job they do and the benefits and everything else to local authorities. So, Grant, thank you once again for coming tonight. Thank you for agreeing to come at some point to do some training for us. And as I say at every meeting, you're quite welcome to stay for the rest of the meeting.
No, I'm going to say, I think in terms of training, more than happy to do it. I don't know what I did at Combined Authority, but I suppose if members want feedback through you, Chair, if there's any specific items they want covered, because what the presentation I would do is the role of external audit and why we're here, and I mean the answer to your question about why they always look at PPE and pension liability. But if there's anything specifically around the audit role, then let us know, and we can probably just tailor a little bit.
Mr. Snow.
So,
just this more of a reassurance, really. Over the years now, you have been able to rely more and more on the efficiency and the function of our own internal audit department. In terms of the amount of work you have to do, have you been able to? You say the work is very robust, that is giving you confidence.
We look to internal audit to give us confidence in the overall control environment. I'm actually not professionally allowed to direct what internal audit do. That's a decision that the sort of UK profession has taken. What I can do, I do look at the plan that internal audit put together, and I think it is in my remit to say if I feel that it's not going to have sufficient coverage, I would make that comment. But I don't direct what they do. They do a risk-based approach. I look at it into overall control environment. I do look at the outputs and see if there's issues there for me as the external auditor that should drive my focus, which I think is picking on what Councillor Trim was saying, that if there's anything coming out of that would identify a particular risk area, then that will become an area of audit focus. But I'm not allowed to directly place reliance on internal audit. Clearly, if they do some work on certain areas of certain testing, and we might look to sort of like pick that up and go, yes, that gives us evidence, but what I'm not allowed to do is direct exactly. You can agree or disagree with that, but that's where the profession went. To the point I was in the USA, I could direct them, but I can't direct them in the UK. So, okay.
But over the period of the year, you can more or less sort of, from your own perspective, yeah, you start sort of rely more on the weather, not direct.
I don't think we rely any more or less on internal audit. We've always had an understanding with them around the work and the environment that they do. We've always looked to work with them and understand the plan. So I think maybe if you went back 10, 15 years now, I'm trying to think now, there may have been a bit more closer working in terms of being able to say, could you test these transactions for me and I can place reliance upon them. And I think that's probably what we don't do or can't do specifically now. You know, and I think there was a bit more around if you've done...
It used to return the managed audit approach.
The managed audit approach, yes. But we've had to move away from that because I think there was keeping that independence and picking up the point of not being too close and that. So I think, yeah, that's where the profession has decided to go. But we do place a lot of reliance around getting, if you look through this report here, around what they do around looking at fraud, what they do around the overall control environment, looking at your financial systems. If they didn't do that work, then I'd probably have to do more work to satisfy myself that I don't need to go and look at that system because I know there's appropriate controls in place.
And we share our working papers and audit reports with you as well. So effectively, Grant and his team are checking the effectiveness of the internal audit team to see how much reliance you can place on the overall opinion that I give on the control environment in my annual report. So that's the way it works now, isn't it?
Okay, thank you all very much. We move on to agenda item 8, which is the Treasury Management Monitoring. Craig, I think your report.
Thank you very much, Chair. Right, try and keep this to the relevant points, keep it short and sweet. The economic summary, the main concerns that are facing the UK at the moment are wage inflation and CPI, but unfortunately the big Brexit word. There's so much uncertainty surrounding that that until we know what's going to happen come the next vote in Parliament, will determine whether we're going in for a hard or soft Brexit. On the plus side though, unemployment is low, but that is obviously causing the concerns because of inflation and wage inflation. The economic outlook, and that's the interest rate forecast that's going forward, looks like interest rates are forecast to go up 1%, 1.25 increase into 2% from December 2021. That's based on an orderly Brexit. So the risks are on the upside. If we do have a disorderly Brexit, this will change with 100% certainty. But we don't know that as yet, but as soon as we do, we can obviously bring that forward. On 5.4 over the page, that's our investment portfolio as at the end of December. Investments are currently at 46 million, which is high, but not unusually high. And for the final quarter, we do expect balances to drop as we don't get council tax income coming in for the final 2 months. And we're anticipating that investments will drop to 36 million by the end of March. I refer to the charts in Appendix A on sections 5.7 and 5.8, and they do show that we have got high levels of investments in money market funds at the end of December. That's due to 2 reasons. One being the Christmas shutdown, where we obviously couldn't get in to make any key investment decisions if we've got cash available, and also counterparties being available to us to actually place investments at the moment have been quite limited. As some banks and building societies approach their year end as well, they structure their balance sheets, so for their close down. And a lot of them aren't taking cash at the moment, unless they want 4-month money, 6-month money, which is outside of the scope that we've got from our cash flow. So that's why we're seeing use of money market funds increasing. The average balances in 5.17 shows that we are still achieving returns at 0.9%, which is well ahead of the benchmark that we use, being either 3-month LIBOR or 6-month LIBOR. What 6-month LIBOR means is that it's London interbank rate. So if banks lend between themselves, that's what they'd expect to get. So we're in excess of the 6-month benchmark there, which is always reassuring. Grant alluded to earlier on about the property fund, and 5.18 onwards shows how the property fund is performing. The last quarter was an exceptionally good performance, with yields increasing to 4.18 and also a significant amount of capital growth, with almost £31,000 against the £2 million that we've got invested. The big change that's coming forward from this financial year, due to the financial changes, is that we have to charge any gains or losses to our investment returns. Now, as it stands at the moment, if things remain unchanged, the difference between our £2 million investment and the valuation of £2 million investment and £1,960,000 there would mean that we'd be charging £40,000 to investment returns. So it's a loss. However, there's been a lot of lobbying and decision making, and after a lot, I suppose it's a long time of lobbying with CITFA and CLG. CLG have agreed to a 5-year mitigation, which means that that charge gets reversed out so it doesn't affect balances. At the end of that 5 years, any gains or losses will hit the revenue account. So that's where the risk is coming in future. If you to look at that, the chart in 5.21, financial year 16-17, looking at that capital growth and loss would have meant we'd have charged £25,000 to the general fund balances. In 17-18, we'd have seen a gain of £45,000 of capital growth across the whole year. So you can see there's some fluctuations there. Now that 16-17, the big reason for that was the referendum vote. That's when we saw valuations drop. So we've got to be able to accept that risk going forward, but we've got these 5-year mitigations to be able to take a view. Is it the right investment? My personal view is yes, it is. Because, when we're receiving yields of over 4% per annum, we're still seeing excellent returns. But at the moment, we're not putting any more money into that. We do keep looking at what the opportunities are, but at the moment, I'm taking the view that we're not putting any more cash into the property fund until, A, we know what's going to happen to property values post-Brexit as well. That's the big risk. Going over the page to page 57 on paragraph 532, I alluded to this last quarter. CLG have formalised the removal of the HRA debt cap, which was set at 89 million. That meant that we couldn't borrow more than that value for the HRA for a capital purpose. We're now looking at how this fits into the financial business plan of the HRA, and when we do actually present budget proposals and shadow budget proposals in February, we'll obviously be able to consider how we can deliver HRA new build, etc. going forward, but not put the HRA at risk. 5.35, the revenue position. Because of the level of investments that we've got, because the balances that we've got were higher than we'd originally anticipated, because primarily HRA has got quite a high level of balances, and investment returns are greater than we predicted as well because of interest rate increases. Both the general fund and the HRA are expected to generate an extra £75,000 each in investment returns. The only other point I do want to raise is on 6.2 and 6.3 over the page, where, as part of our Treasury strategy, we do set limits. And for transparency, I need to bring these to your attention. We set a limit of about £8 million per institution to make sure we've got diversification of our investments. On 3 dates, so 27th of December, 31st of December and the 1st of January, those limits were marginally breached with Lloyds Bank. Now that was because we have the shutdown period, we haven't got the staff available to actually make investment decisions on those days, and because of segregation of duties, if I was to sign into the bank, I can't input a transaction and send a transaction. So staff availability is the other side of it. The risk to the council was low because counterparty quality and the fact that the majority of those investments are in our bank accounts, so they're just liquid cash anyway. It's not like investments have been placed for 6 months and things like that. But for transparency and because it was a marginal breaching limit, I needed to bring this to your attention. And that's all I've got to raise, Chair.
Any questions?
Chair, very quickly, Peterborough City Council, I asked about this last time, I ask about it every time. Local authorities still seen as suitable counterparties. the answer you gave me last time was you look at each one on its merits. So has that changed?
No, what we will do, if there is an opportunity, we do get investment brokers contacting us quite frequently with opportunities, and we will say, right, which council is it? We will have a look at their accounts, and this is where we make a judgment call. Look at their value for money conclusion, look how their balance sheets are structured, look at their strategies to make sure that just because they're a council, we don't say they are a safe investment. We will look at how they are structured.
So that's as before. The only other thing was just on page 57, 5.29, the 5 million interest-free loan.
That's it was only a small value, and it was with a company called Salix, and Salix is the company. And what it was, they issued interest-free loans available for it was energy efficiencies. And this was one where we'd done some capital works to Harefield Road for energy efficient lighting. So if there was an interest-free loan opportunity, it was a case of yes, we will take that.
Any more questions?
Just coming back 5.4, I'm just wondering whether there's some form of alignment there. Now, our total management investment, right? Between December and March, that's gone up.
Yeah. So at the end of March, we've got 32 million. Yeah.
I'm coming down to the net indebtedness there. Again, it's gone down.
Yeah.
When I look at the arithmetic there, the figures are almost identical. I'm just wondering whether you are sort of aligned.
The net debt position is our, so for example, if you take the 31st of December 18, it's our 46 million, less our almost 81 million pound of borrowing. So it's literally taking one from the other. So at the end of March, we'd only got 32 million pound of investments, but our borrowing figure was pretty much the same.
Yeah.
So our net position was obviously greater at that point in time.
Just sort of aligned the coincidence.
No, it's...
Actually,
the net debt position is something we do have to show and disclose as part of the Prudential Code.
Yes.
But yeah, it's
because I just the total managed investment there, difference between is about 14,214, and then when we come down again, the net indebtedness is about 14,22. Just wonder whether sort of ensuring it's just by coincidence.
I can't see. Which figures are you looking at? Sorry.
Right. Okay. If we come back to the total managed investment, right?
Yep.
In March 32, and then in December we got 46, right?
Yes.
That's a difference there for about 14,000, 14
million, yeah.
Right. If we go down into our net debt, right? 48 in March and then 34, which is gone down. I'm just looking at the difference.
It is because of our investments.
Pardon?
Because the net debt is literally taking our borrowing figure, less our investments, so it's a case of what's the difference. And because our investments have increased by 14 million, obviously our net debt position is reduced by 14 million.
So it's just almost 10. That's all right.
Okay, thank you. Craig, just one point. When we have a look on page 63 at Appendix A, when I look at where it calls itself investment portfolio maturity split, this is obviously, as it states, our investments, the investments of which are used for a variety of lots, the funding that we put in and get out of investments are what are used. And looking at the figures that we have here, and you've said that they're likely to go down to about 36, I think, in March. What I think people get very confused about, and I see it quite a lot, is that people think that these are money that we have in reserves that we can spend.
Yeah.
Could you just do as an explanation of exactly what we're talking about here? Because it isn't money that we can, I don't think it's money that we can spend.
No, our investments are made up from a number of sources. So we've got general fund balances, which as at 31st of March last year was £1.6 million, of which £1 million is our minimum working balances, so cannot be touched. We've got earmarked reserves, which earmarked is exactly as I say, they are set aside for a specific purpose, whether it's risk management, future capital expenditure. We've also got HRA balances. We also have cash flow as well. So some of these investments are purely cash flow investments, so they're not available for day-to-day spending, for new decisions. Taking as an example, somebody might pay their council tax in full up front at the start of the year, but obviously we need to drip feed that through the financial year. Hence why our investments are going to be dropping by £10 million, because we're not getting a significant amount of council tax income during the last 2 months. So that's when we see the cash flow side of these investment balances dropping. But what I can do for the future is actually put more of a detailed explanation. I did put a table in the Cabinet report in the mid-year review, which broke down how these investments are made up to say these are what you've got as controllable that you can allocate for future spending requirements, and these are ring-fenced as such. But I can try and put something like that in the
I think
tables.
it might be useful if you could do a short report for us, just to the audit committee, just so that we better understand exactly what these huge sums of money that people seem to think we've got to spend
So what's
can
controllable,
be
what's not
used
controllable,
for.
yes.
I also think it might be useful, because the minutes do go out as a public item, if perhaps, Wendy, you could perhaps put some of those detail into some of the minutes, if that's possible. I'm sure Craig would be able to help you with the figures if you could do that. That can be done, Philip, yes? Is that okay to do that?
It would be unusual to do that, I have to say.
But I think it would be useful for it to be in the public domain exactly what those figures are for, because people don't watch the recordings of this meeting.
What I won't be able to do, because it's all generated from the balance sheet, we only generate the balance sheet at the end of the month. So I can put the table in that we did before, that was in Cabinet as at the 31st of March last year, which breaks down what those were. So at least there's some transparency there to say that's how these investment balances
I've
are made
heard all
up.
these millions called some very strange names over the last, over a period of time. Right, well, thank you for that, and we look forward to the report that you're going to give us at the next meeting. So, thank you again, Craig, for your report. And I think you just have one item left on the agenda item 9, which is yours, Philip.
Yes, thank you, Chair. And very simply, this is just a report for noting. It's just to alert members to dispensations granted since the last meeting.
Okay. Anyone have any comments they wish to make? Kyle?
Yeah, thank you, Chair. I've just got 2 brief questions, if I may, Chair. Firstly, could I ask, with regards to the Wenbrook Community Centre, what relevance does it have to the borough plan? I'm just curious. And secondly, why has one dispensation been granted for 4 years and another 1? Again, I'm just curious as to why it's been 4 and 1 year.
I can't be specific in terms of the Bedworth Community Centre. I believe, anecdotally, that they may well be the recipient of monies through a Section 106 obligation from a development.
Right, okay.
So I think,
Yeah.
but I don't know. The reason for a 1 year and a 4 year is principally because, as far as the borough plan is concerned, if the borough plan is adopted this year, then it won't need the need for the dispensation will fall away. Whereas obviously the 4 years is on the assumption that Councillor Lloyd will be the director for the whole of that period.
That's great, thank you.
If I could just expand and agree with what Philip has said about the Wenbrook issue. When there was a planning application for the houses on Gypsy Lane, part of their proposal was that there would be 106 monies allocated to Wenbrook Community Centre on the basis that that plan could still come back, and that could still be, actually, because it's in the local plan, it could come back and it could still be in there. She knew, dispensation had to be granted for that. Right, and is there anything else anyone wants to raise? Any other business? No? I declare the meeting closed. We can all have an early tea, or a minute.